Titans tumble, markets seesaw, governments put up massive bailouts. But where did this financial crisis come from? And how will the next U.S. president deal with a ticking death bomb?
From the floor of the New York Stock Exchange, I'm Avi Lewis, and this is Inside USA. For weeks now, what happens here on the floor of the New York Stock Exchange has been watched with laser intensity around the world. Trillions of dollars of paper wealth have been wiped out, regained, wiped out again. A mountain of debt has been transferred to the public purse, and network news has followed every twist and turn in real time. But in a period of such momentous change, there's scarcely time to ask questions about the nature of these events, like what are the roots of this crisis, and could it have been avoided? On this week's Inside Focus, we'll hear from a chorus of different voices, from Wall Street insiders to people who couldn't even get in the door here, about where this crisis came from and how it will shape the next government of the United States.
It's the Shopocalypse! We shocked ourselves to death!
We're in the midst of a serious financial crisis, and the federal government is responding with decisive action.
On the eve of the U.S. election, Wall Street is a ball of nerves.
We have to work quickly, in bipartisan fashion, to resolve the immediate crisis and to avert an even broader economic catastrophe.
Grave warnings echo, an epic bailout unfolds.
If we do not act, every corner of our country will be impacted. We cannot allow this to happen.
The architect of two market bubbles is humbled, his legacy in tatters.
Those of us who have looked to the self-interest of lending institutions to protect shareholders' equity, myself especially, are in a state of shocked disbelief.
For Islam Zugair, it's just another busy day at work.
Well, let's talk about it. I have to run, but let's talk about how we do this in the least invasive way. How we get resources in without rocking the boat.
For someone in the business of restructuring distressed companies, financial crisis means business is booming.
Lots of times the phone will ring and the company will say, look, we haven't access to a line of capital from a bank and they've cut us off and we need help. We need help either renegotiating our debt or in some instances we need to file for bankruptcy.
A reminder that despite the deluge of dire economic reporting, there is still money being made on Wall Street.
The restructuring profession will get very busy and will do very well in the next couple of years and there are others that will benefit from it as well, that's for sure.
Like who?
You have a lot of funds that have been set up specifically to buy assets on the cheap. You know, there's a lot of opportunity here for guys on Wall Street.
In a time of wild market swings, volatility itself is a major opportunity. On the trading floor, money is made every time the market moves, whether up or down. But perhaps the greatest opportunity here is the U.S. government's program to stabilize the banking system, the $700 billion bailout itself, led by Treasury Secretary and former Goldman Sachs CEO, Henry Paulson.
Paulson has handled the bailout like a lobbyist for the financial institutions in New York City, not like a custodian of the trust of the American people. Any significant financier can see right through what he's doing, and it's quite shameful.
Robert Johnson is a consummate insider, both on Wall Street and in Washington. In the 1980s, he was chief economist to the U.S. Senate Banking and Budget Committees. In the 1990s, he managed a massive hedge fund for George Soros.
And here they're doing a cosmetic injection as opposed to a real one.
Over the past weeks, Johnson has been tracking Henry Paulson's ever-shifting bailout plans and the terms on which banks and other companies are receiving public money. He thinks the secretary's apparent scrambling reveals a pattern.
What he's doing in big picture terms is trying to give taxpayers money to the banks who made a mess without taxing the banks, without hurting their stockholders. There are two types of energy in American politics, money and votes. And the most violent thing that happened was 5 weeks before an election, when votes are at their relative high. They did the equivalent of thumb their nose at the votes and took the money.
This was the first major act of Congress, I think, in American history that there's not been any oversight, there's not been any congressional hearings, there have been no testimony from witnesses. Hundreds of economists have come out against the debt bailout, saying it's going to just load the economy down with debt and it's a disaster.
With the economy dominating the election campaign, it has become clear that debt on every level is at the core of this crisis. According to the Federal Trade Commission, the average U.S. household has 8 credit cards, with $9,000 owing on them. And that is just for starters.
Most American families are borrowed to the hilt. They're paying 40% of their income on housing costs, another 15 to 20% in debt service. And when you have that large an amount of income that has to be paid every month, there's simply no way in which banks are going to lend more to them.
Especially when banks themselves are deep in debt. Wall Street giants are choking on toxic paper, and the government has come to the rescue by funding a string of mergers, propping up individual firms, and then the big bailout. All of it piling up the national debt by more than $1 trillion. Let's take a look at where all this debt comes from, why it grew so quickly, and what were some of the key decisions that allowed it to spiral out of control. First of all, at the root of this debt debacle is the household mortgage, and a process in which those debts became commodities.
Once upon a time in America, you could go to a bank, take out a mortgage. That mortgage broker would maybe know you and your family. That bank would hold that mortgage, and then for the next 30 years, you would pay that bank back. Once we had deregulation that said, hey, that bank no longer has to hold on to that mortgage. They can slice it and dice it and sell it to a variety of banks all around the world. Then we sort of set in motion a process whereby individuals just have the incentive to make that money today, but they're not left holding the bag when the individual goes under.
Under the leadership of Federal Reserve Chairman Alan Greenspan in the 1990s, the trade in derivatives saw explosive growth, especially those debts that were turned into securities to be traded and retraded.
A derivative is not an underlying asset, like a stock or a bond or a barrel of oil. It's a bet on the price of an underlying asset. So a derivative is an ownership of a certificate, which is like a casino bet. And the casino got very complicated. The casino became bets upon bets of the remix of the remix of the remix of underlying securities.
Collateralized debt obligations, credit default swaps. These and other mortgage derivatives are the notorious exotic financial instruments that precipitated the crash and brought down some of the biggest names on Wall Street. But the toxic debt is all still out there. Default swaps, essentially insurance policies for these risky securities, are now a $55 trillion business. It's often called the dark market because it lies completely outside the realm of government scrutiny. In fact, the true value of these investments is so cloaked in confusion that many of the dealers themselves don't know what they're selling.
It's almost impossible to explain derivatives or how much they are because nobody really knows. So it's just like a black hole out there, and it's threatening to bring the whole system down.
And so we got to the point where people with great mathematical education could be sitting as the chief financial officer of a company and say, I don't know what I have. And every night, these major banks and investment banks settle billions, if not trillions of dollars. And they don't know if they're solvent, they don't know if the other guy's solvent, and they don't know how to say, I'm being safe when I'm doing this.
So why were such mysterious investments so popular? Because they also happen to be monumentally profitable. Since 1997, the Big Five Wall Street brokerage houses have handed out $250 billion in bonuses alone. It was a long run of record-smashing profits, and it was fueled by a surge of debt. The more debt the big investment banks took on, the more trade they could do, in trading debt.
The final item on our agenda today is a recommendation from the Division of Market Regulation.
Which brings us to April 28, 2004, a routine meeting in a basement room at the Security and Exchange Commission in Washington, D.C. The big investment banks, led by none other than Henry Paulson, CEO of Goldman Sachs at the time, wanted the SEC to remove the limit on the amount of debt they could carry, allowing them to leverage up and gamble vastly greater sums in derivatives.
If anything goes wrong, it's going to be an awfully big mess.
In just 55 minutes, the regulator agreed to this deregulation.
Unanimous. Thank you very much. And we are adjourned.
And the debts of the Wall Street titans went on to soar.
Somebody said, like, how do you predict the failures? It's pretty simple. Look at the leverage ratio on February 1st. Put it in a line from the highest to the lowest. All the high guys went bust.
In this opera of overblown debt, it is the people who are taking on the greatest burden. The national debt of the United States has more than doubled in just a matter of weeks. On the famous debt clock in New York City, the dollar sign has been replaced by an extra digit. Some economists say the total figure will top $13 trillion this year. With economic forces this titanic, it's hard to remember that the crisis has its roots in the debts on something as solid as people's homes. But as Americans head to the polls, there is a parallel crisis here that is playing out at the kitchen table. Thousands of people are losing their homes every day. 5 million foreclosures are expected in the next 2 years. With unemployment on a steep climb, that number will only grow. And so far, no bailout has been proposed for the homeless.
Okay, some people lost money on Wall Street, but a lot of those people are people who already had money. And they're not going to be eating at soup kitchens tonight. Morris is in between the D and the 4 train.
Outside a welfare office in Harlem, Linda CONTES and SOPHIA BRYANT are hard at work. They volunteer for Picture the Homeless, a group that offers advice and advocacy for people struggling to find affordable housing.
We had a house. We had a townhouse we owned, we were paying a mortgage on, we both had jobs, we had cars, we had the typical middle-class American life. I got sick, couldn't work anymore. Went into the hospital, was doing chemo and radiation on a weekly basis, daily basis. We got behind on our mortgage, and instead of the mortgage company actually wanting to sit down and look, we explained to them the situation, we explained to them what was going on, give us a couple more months, I'm getting better. We were only behind for like 3.5, almost 4 months we were behind, and they foreclosed on us, took everything. And I mean, literally took everything. We were not even there when they, the bank came and locked it up and would not let us have anything out of the house, nothing.
This trickle-down theory hasn't worked. It's only trickled up, and I think this bailout is a perfect example of even more trickling up and a huge redistribution of wealth taken largely from America's working people and given to those who have made the most of a very unfortunate situation.
And that's how it all goes. It starts at the top and it trickles down. How about let's start at the bottom for a change, and then let's try and build it up to the top. You know what I'm saying?
The game, the rules, the structures were all to fortify wealth at the top 1 to 3%. And at the end, through their compulsion, they blew up their own system. And now we're transferring what I will call the wealth of our children and grandchildren into their pockets to bail them out.